On January 15, 2026, Asia-Pacific markets delivered a day of sharp contrasts. As the sun rose across the region, investors braced for a session shaped by uncertainty and opportunity, with every headline and data point carrying the potential to shift the mood on the trading floor. Investors responded to a mix of local and global signals, creating a patchwork of winners and losers. The mood was tense, as some sectors surged ahead while others faltered, reflecting the complexity of today's interconnected financial world. South Korea's market soared on central bank news, with the Kospi index rallying after policymakers signaled a supportive stance for growth. This optimism rippled through Seoul's financial district, fueling hopes for a strong start to the year. Meanwhile, China's tech sector stumbled under regulatory scrutiny. New government measures and ongoing investigations weighed heavily on major companies, leaving investors in Shanghai cautious and uncertain about the near-term outlook. Japan paused after a strong run, with the Nikkei index taking a breather. Traders in Tokyo weighed recent gains against global risks, highlighting the region's diversity and the need for careful strategy. These moves underscored that Asia is not a single market, but a collection of unique economies, each shaped by its own forces. From policy shifts to demographic trends, every country brings its own story to the regional narrative. Central bank decisions, regulatory actions, and U.S. market sentiment all played pivotal roles. The influence of global events was felt in every corner, as Asian markets reacted to both domestic developments and international headlines. The day's divergent outcomes had real consequences for investors and corporations, influencing everything from confidence to expansion plans. Boardrooms buzzed with debate as leaders weighed risks and opportunities in a rapidly changing environment. Understanding these drivers is essential to grasping the region's future. Analysts, students, and professionals alike must stay alert, as today's lessons will shape tomorrow's strategies. The story wasn't in the averages, but in the specific triumphs and setbacks from Tokyo to Sydney. Each city, each exchange, contributed its own chapter to the day's unfolding drama. For investors, the lesson was clear: pay attention to the details. Success in Asia-Pacific markets demands vigilance, adaptability, and a willingness to look beyond the headlines. Asia's markets are a complex puzzle, and every piece matters. In this dynamic landscape, understanding the nuances can make all the difference between seizing opportunity and missing out. South Korea stole the spotlight in global financial markets today, drawing the attention of investors and analysts around the world. The Kospi surged 1.58%, closing at a record 4,997.55, a level never seen before in the index's history, and a clear sign of the market's growing strength. This historic high reflected a wave of investor optimism and confidence in the country's economic outlook, as both institutional and retail investors showed renewed enthusiasm for Korean equities. The rally wasn't limited to blue chips. The Kosdaq, which tracks smaller and tech-focused companies, also climbed nearly 1%. This signaled broad-based strength across sectors, from technology to manufacturing. The catalyst behind this surge? The Bank of Korea's decision to hold interest rates steady, providing much-needed stability and clarity for businesses and investors alike. With uncertainty about monetary policy removed, investors poured into equities, driving the market higher and fueling a sense of optimism that rippled through trading floors and online platforms. Breaking a record high often sparks a virtuous cycle, attracting more capital, boosting sentiment, and encouraging even cautious investors to participate in the rally. International attention quickly followed, with headlines around the world reinforcing South Korea's status as a regional bright spot and a key player in the global economy. The Kospi's new peak set a benchmark for future performance, raising expectations for what South Korea's markets can achieve in the months ahead. January 15th became a milestone for South Korea's financial markets, marking a day of progress and renewed ambition for investors and companies alike. As the trading day ended, a sense of achievement and momentum filled the air, setting the stage for what could be another remarkable year for South Korea's financial future. The Bank of Korea's decision to keep its benchmark interest rate steady at 2.5% was widely anticipated by analysts, but it was also a pivotal moment for the country's financial landscape. In a climate of global uncertainty, this move was seen as a signal of caution and careful stewardship. By holding rates, the central bank reassured investors and markets alike, emphasizing a preference for stability over aggressive stimulus. This approach helped calm nerves among traders and financial professionals, who had been watching for any signs of volatility. The Bank of Korea faced a delicate balancing act. Lowering rates might have provided a short-term boost, but it also risked weakening the won even further. A weaker currency could drive up import prices, fueling inflation and eroding consumer purchasing power. Instead, policymakers chose to prioritize currency stability, even if it meant limiting their options for stimulating the economy. This decision reflected a broader concern about maintaining confidence in the won and protecting the country's economic fundamentals. Despite these efforts, the won still slipped 0.2% against the US dollar, trading at 1,466.6. This modest decline underscored the ongoing pressure facing the currency, as global investors weighed risks and opportunities. The Bank of Korea's official statement made it clear. Currency dynamics were at the heart of their policy decisions. The central bank acknowledged the challenges posed by external factors, including shifts in global interest rates and capital flows. For investors, the message was unmistakable. The central bank was acting with prudence, demonstrating both caution and confidence in its approach. This reassured market participants and reinforced trust in the institution's leadership. The steady hand at the helm helped fuel the Kospi's record-breaking run, as investors responded positively to the sense of stability and predictability. This episode highlighted just how closely intertwined monetary policy and currency markets are, especially in an open, export-driven economy like South Korea's. By choosing stability over short-term gains, South Korea's central bankers earned the market's respect and trust, reinforcing their reputation as careful stewards of the economy. The result was a new high for the Kospi, a milestone built on confidence in sound policy and the promise of continued economic resilience. Japan's Nikkei 225 finally paused, slipping 0.42% after consecutive record highs. This pullback reflected profit-taking, a natural breather after a strong rally. Yet, the broader Topix index rose 0.68%, showing underlying market strength. Investors rotated out of high flyers and into undervalued names. Toyota Industries stood out, surging nearly 6% after a higher takeover bid from Toyota Motors. The yen firmed slightly to 158.34 per dollar, after recently hitting an 18-month low. Currency moves remained in focus, as a weaker yen helps exporters but raises inflation concerns. Market participants watched for signs of government intervention to support the yen. The day captured Japan's mixed signals: profit-taking, corporate wins, and currency vigilance. Tokyo's market showed resilience beneath the surface. Investors balanced caution with opportunity. In contrast to Seoul's rally, Hong Kong and mainland China faced a tough session. The Hang Seng fell 0.66%, while the CSI 300 dropped 0.42%, reflecting widespread caution. The main culprit: renewed regulatory fears targeting China's tech sector. News of a government investigation into a major company sent shockwaves through the market. Investors, wary of sudden crackdowns, pulled back sharply. Regulatory uncertainty has become a defining risk for Chinese equities. Even strong fundamentals can't shield companies from policy shocks. The day's events highlighted the persistent unpredictability of investing in China. A single announcement was enough to trigger a broad sell-off. The regulatory storm centered on Trip.com, whose shares plunged 17.2% in Hong Kong. The trigger: China's market regulator launched a probe into alleged monopolistic practices. Investors reacted instantly, fearing fines or forced restructuring. The sell-off wiped out billions in market value and rattled the entire tech sector. This episode underscored the ever-present risk of government intervention in China. No company, however large, is immune from sudden scrutiny. The fallout spread to other tech stocks, amplifying the sense of vulnerability. For investors, the message was clear: regulatory risk is a constant in Chinese tech. The Trip.com saga reinforced why caution is warranted. Australia's ASX 200 rose 0.47%, echoing South Korea's positive momentum. Local factors and insulation from China's regulatory woes buoyed sentiment. India's markets were closed, leaving a gap in the regional picture. When India reopens, it will have to digest the week's global developments. U.S. markets had pulled back for a second day, with the S&P 500 and Nasdaq both retreating. The tech sector led the decline, pressured by news that Chinese customs blocked Nvidia's advanced chips. This highlighted ongoing US-China tech tensions, which reverberated across Asia. The weakness in US tech stocks set a cautious tone for Asian trading. Chip makers like Broadcom, Nvidia, and Micron all fell, dragging sentiment lower. The ripple effect was felt from Tokyo to Sydney. Global tech rivalry remains a key driver for Asia-Pacific markets. Currency moves shaped the day's market action. South Korea's won slipped 0.2% against the dollar, reflecting the central bank's tightrope walk between stability and growth. A weaker won helps exports but risks higher import costs and inflation. The Bank of Korea's steady policy aimed to support the currency without stifling growth. In Japan, the yen firmed to 158.34 per dollar after a long slide. While a weak yen boosts exporters, it also raises domestic cost concerns. Markets watched for possible government intervention to stem volatility. Currency swings added another layer of complexity for investors. Exchange rates are now as important as interest rates in shaping market outcomes. The interplay between the won, yen, and dollar remains central to Asia's financial story. The day's events reinforced a key lesson. Asia is not a monolith, and diversification is essential. South Korea's record high contrasted sharply with China's regulatory-driven losses. Local drivers, policy, regulation, corporate news matter more than ever. Japan's mixed session showed that even in bull markets, consolidation is healthy. US-China tech tensions and currency moves will continue to shape the region. Investors must watch central banks, regulators, and global supply chains closely. January 15th offered a snapshot of a region in flux, full of opportunity and risk. Success will go to those who understand the nuances and adapt quickly. The lessons from this day will echo throughout the year for Asia-Pacific investors.